Good day, everyone. Dan, Sharpe Trade. As we have stated previously, we have come to the point of acceptance at Sharpe Trade that many of the things that you will hear me say are simply principles that I am repeating over and over and over and over and over and over again. One of those principles is you must understand risk. You must understand risk. You must understand there are various forms of risk. We said that in the very basic money management series of videos. There are different forms of risk, geopolitical risk. As Knight Capital demonstrated to everybody, technology risk. Little bit of joke there for those that were around for that particular incident. But technology risk, the risk of, just infrastructure problems, things like that. There are many forms of risk. But a lot of times what we're talking about is, when we mention risk, is understand what you're doing with an iteration. With a series of trades, with many trades, 100 trades, 200 trades, 300 trades, you must understand what you're doing in the form of the risk of what you are doing. There's a very specific reason that you will always hear the veterans, the people that have been around for 20, myself could be 21 years, 30 years, 40 years, even longer. There's a reason why you will always hear the market veterans say this. And the reason is, as we have all stated before, and I'm going to say over again, the street is littered with the corpses of cowboys. We have this one series, at the time of this recording I still have to finish it up, but it is a series on, do you truly understand markets? Do you truly understand investing? Do you truly understand trading? Because there is so much nonsense out there. But the street is littered with the corpses of cowboys. And a cowboy, if you are new to this whole concept and you have not heard us talk about it before, is basically somebody that goes through their iteration, their series of many, many trades, and they don't understand the risk of what they're doing. And without even consciously understanding it, they're ramping up the risk. They're accepting more risk without understanding that. And eventually, the tax man comes to collect his bill. We just sort of call them cowboys, sort of like the Old West, somebody just living just gunfight to gunfight to gunfight. Eventually, you meet somebody, which in this case it would be the big bag gunfighter of actual risk.
Well, I didn't think you had it in you.
I'm your huckleberry.
Why, Johnny Ringo, you look like somebody just walked over your grave.
Fight's not with you, Holiday.
I beg to differ, sir.
And they slaughter the gunfighter. And that's why we say the street is littered with the corpses of cowboys. Because what inevitably happens is they're ramping up either the amount of risk they're taking or the level of risk or a specific type of risk that they are accepting, and they blow up. And when they blow up, it's not just a matter of, they lost their money. Because here's the thing. If that was the case, if they only went back down to zero, it would be like, well, why not accept the risk model for a long period of time? And if I understand that, then just sort of walk away from the table. Right? Just walk away from the table. If eventually they're running something and it looks great and it makes a lot of money real quickly, and in a 1 year time frame you can point at them as like, ha ha ha, look at this guy, he's up 300%, and look at Dan, he's down there at 7%. He's only made 7% in the last 4 months, and this guy's up 300%. Ha ha ha, that Dan guy, he sucks. Well, we can understand that now. But some people might say, well, I'm going to do the risk model that the guy over there is doing because I understand that, it's taken on a little more risk. But hey, I'm going to gamble with it and be up big in a year. You can do that. I'm not going to say you can do that, but here's the problem. We never know what the next binary trade will bring. That's the problem. And when it comes to collect, it's not just a matter of you lose all your money. Usually what happens, and why we say the cowboy is dead on the street, or the street is littered with the corpses of cowboys, is because since they did not understand the risk of what they were doing, it's much worse than simply losing the money that you had gained, right? Because otherwise people would say, well, hey, what the heck? Why not be up, $1 million this year? And then I'll just stop doing that. Then I'll just stop doing that and I'll just walk away. Because we never know what the future is going to bring. So we don't know if that next binary trade will be the one that kills you. That's just first of all. And second, this is sort of what I've been leading up to. And most importantly, since they did not understand the risk of what they were doing, it's not a matter of they simply lose, $1 million or $800,000 or whatever. Usually they lose that $800,000 and then they owe another $20 million. So it's serious stuff. And I've seen two cases of this just recently. Someone saying that they never have trading losses under any circumstances, and they're always correct, and they know more than everybody else. See, these are the personality traits of those cowboys that eventually get slaughtered. And they can go on for a long time. They can go on 1 year, 2 years, 3 years, 4 years. They can go on for a long time this way. But these are the personality traits that you'll hear in a cowboy, that basically they know more than everybody else. There's a difference between that and being very confident and even a little bit cocky. I'm a little bit cocky. I've got an ego. I do understand that. But I also understand that at any moment, and this is the reason why I trade the way I trade, why I've been able to do this for 20 years, I realize that at any moment that market can come along, liquidity can dry up like that, and that's why I say liquidity's there until it isn't. Liquidity can dry up like that, which is also why you want to be concerned with how thick is the market that you're trading. But liquidity can just disappear. See the Swissy move of a few years back. Liquidity's just gone. I understand that that can happen literally at any second. The Swissy move, it happened literally in the blink of an eye. Just the blink of an eye. So I understand that. So although I am cocky, I do have a bit of an ego. I keep it in check, and I remain humble in the face of the market, because I have seen what the markets have done to other individuals, and they can eviscerate anybody. It doesn't matter how big you are, doesn't matter how smart you think you are. Trading and investing and trading really has nothing to do with intelligence anyways. But it doesn't matter how much you think you know more than everybody. You keep humble in the face of the markets. To put on the risk we put on in some trades, you got to be a little confident, and even sometimes it's just false bravado because you realize the beast you're dealing with. But you need that for a little bit of strength, psychological strength, right? That's sometimes why you hear the cockiness, sometimes why you hear the bit of the ego. But don't confuse that with me sitting here saying, I know more than everybody, because I don't. I run into new things all the time. So as we were saying, the personality traits you'll hear of cowboys are, they know more than everybody, everybody else is stupid, everybody else is just dumb and handing them money, which is so inaccurate, because there are multi-layered periodicities and so many institutions doing many things, and the databases are filled with those of us who are profitable and trading profitably year after year. So the idea that everybody is handing them money and they are the one person that's profitable is arrogant at best. Probably a little more along the lines of someone that has problems with delusions of grandeur and self-delusion. But they know more than everybody. They're always right. They never have any trading losses of any kind. And everybody else is stupid because they don't have the secret method or process. I've seen 2 examples of that lately. And people claiming my accuracy rate is 100%. Be very clear about what I'm about to say. With an inverted risk profile, you can have ridiculously high accuracy rates. Ridiculously high accuracy rates. But with an inverted risk profile, eventually the tax man comes to collect. Heck, we ourselves, something I haven't really shown clients of the Sharpe report yet, but I want to get to because I'm demonstrating something in real time with long short trading. There haven't been a lot of long short trades, right? There's been some option stuff. There's been the beginning strategy. There's been the second strategy. We're doing that every month. But I'm specifically slowing down the long short trading, A, because of the market environment, but B, I want to illustrate to them something to them that you can increase your accuracy rate, right? You want to know how to do it? Heck, I'll just tell everybody because I haven't shown you the whole process, the processes we keep with folks at the short-term trading course. But I'm going to tell you how they do it. And through the grapevine, I've just heard things fourth and fifth hand. That's how this particular individual is doing it. All they're doing is they're entering a trade that has some sort of trigger that they think looks good because of some sort of belief, which we all need a belief whenever we go into a trade. I'm not knocking their belief on the trade. I'm knocking their lack of understanding of risk and what they're doing, and when the tax man comes to collect, it can eviscerate them. What they're doing, and this is all they're doing, is getting into a position, and there's some capital left over. So let's say they're buying. They're buying ABC stock because they're a heavy believer in ABC stock or a derivative, something like an option or an ETF, and they're getting into it, and they buy it, but there's a lot more cash in the background. Now, if that moves against them, by let's just say 2 standard deviations, then they take all of that capital in the back and they average down on the entire position. Now there are real mathematical reasons why that can work for a long time. And since it can work for a long time, the accuracy rate's going to go up. Unfortunately, it depends on how much they average in on and how much of the capital they take. What they're creating for themselves is something we refer to as an inverted risk profile, which means the accuracy rate could go up dramatically, but it's not fail-safe. I only need to point to the recent move in the Swissy, in that currency, which is rare, but it does happen, which is, moves like 20 standard deviation moves. So yeah, they averaged down, great, wonderful, and they used all this capital, and then the capital that they use, they've built up, that they average down on a 2 standard deviation move, then the market moves 20 standard deviations or 12 standard deviations. One of these wild things you don't get very often, and they're eviscerated. Because those moves do not happen very often, they have a high accuracy for a long period of time. I'm going to show folks that with long short trading, right? But the whole process we're doing with long short trading, that's something I would like to demonstrate. But because I'm also trying to demonstrate with that process and what I'm doing in real time, I'm trying to demonstrate how to learn patience, how to learn how to sit on your hands, and very important lessons like that. But eventually we'll get there. I can tell you right now we're going to get there. I've been meaning to do this. I've said several times to our clients, there's something specific I want to show you. Just so you have a sneak peek, you're one of the clients been looking at long short trading, you just got it ahead of time. Okay? You just got it ahead of time. But, see, the thing is, with that process, I understand that those 20 standard deviation moves are possible, and they do happen. And they have ended careers. Because I understand that, I build the rest of the portfolio in a way that it could absorb that shock of if that happened to me, and not only absorb that shock, but begin to recover. Cowboys do not understand that because they are so in love with their own intelligence or perceived intelligence, and they're so in love with their own delusions. So since they are so in love with their own delusions, they cannot admit that. Their narcissism is literally through the roof. So they can't admit that because to admit that is to admit things that they don't want to personally admit to themselves and face levels of shame and guilt or whatever it is, mommy daddy issues in the background that they don't want to face. And so when those 12 standard deviation moves happen, it's quite a mess, and the blow-ups are quite spectacular. But see, can you do what they're doing? Yeah, absolutely. But you have to build everything else you're doing in such a way so as to absorb that shock in case you get one of those 20 standard deviation moves. Now, to highlight that point that you could have 2 individuals, one understands risk, one does not, approaching the exact same move in the markets with the exact same process, you need look no farther than the Swissy move, the Swiss franc, right? We just refer to it almost as the Swissy move that happened. Gargantuan move. Now, some know that I was trading that exact currency right up until that happened. And I had been involved in this goat rope where I was using one pair to hedge off another pair and to recover, ironically enough, which is a similar approach. And I decided to unwind the entire thing, I swear to you, people saw me do this, a day before the Swissy move happened. A day before. Now, when it happened, it was gargantuan. People were calling it the currency move of that year, actually the market move of that year, because it just went so far beyond just a 2 standard deviation move. It was explosive. It happened just literally in the blink of an eye. It just opened up that much lower, right? Now, here's my point. Although I was not in that pair, I went back and looked and sort of tried to determine what damage would that have done to me if I had still been using that cross against another cross that I was engaged with. What would have been the damage? The damage would have been minuscule because I had done everything with my position sizing in such a way that the entire portfolio could have absorbed the shock. But you only need read through the news that there were many other people with the exact same move also averaging down and doing things like that were not only wiped out, they lost everything and they owed their broker money. That's a clear example of what we're talking about and why we say at the root of it, you have to understand risk and the risk of what you're doing. Okay? Just beware of the folks that say that they just, know more than everybody else. They're better than everybody else. They never have any trading losses of any kind. These are typically the hallmarks of somebody that doesn't understand the risk of what they're doing. Okay, or doesn't want to face. That's not going to happen to me. Well, as we say, the street is littered with the corpses of cowboys. So, with that, we hope you've enjoyed this entry. If you have enjoyed this entry or enjoy what Sharpe Trade produces or tries to do, what we're trying to do as a firm, go ahead and hit that like button. If you haven't as of yet, go ahead and punch that subscribe button. We appreciate it. And you can always check us out on Facebook, on Google+, on Twitter. Heck, we're all over the place. And as always, that has been what it's always been. It's simply been our thoughts, not yours, for whatever the heck day it is. As always, stay safe, trade well, and remember that love doesn't cost a dime.